Welcome back, everyone. Michael here with Offshore Citizen. I recently had a client ask a question about risk and kind of how I define risk, mental checklists, etc. in investing. And so I figured today I would go through and cover with you a little bit about that topic and, just give you a brief mental model for how I think of it. I'd love to hear how you guys think about risk. Maybe before you listen to what I hear, you could put down in the comments below, what is risk to you? How do you assess risk? What do you kind of consider high or low risk, etc.? And we can see how our answers compare. So before we do that, if you haven't already, please hit the subscribe button, hit the all notifications. Really appreciate your subscription. Thank you very much for the support. It's very wonderful. And if you'd like help with the subjects of international tax optimization, asset protection, forming companies, opening bank accounts, getting residencies, getting citizenships, investing abroad, etc., please reach out to me. You can book a call. calendly.com/Michael-Rosmer. There's a link in the description below. Or send a message through our websites, offshorecitizen.net and offshorecapitalist.com. Okay, so I started talking a little bit before about investing and some of the ways to optimize investing. Now, I think the most basic thing to think about is what does it mean to risk? And risk is basically about the chance, the probability and severity of how much money gets lost, right? So I say, okay, well, what is the chance that things don't turn out, right? What is the chance that things go bad? And what are the losses in the event that it goes bad? And I think we can consider these both sides, right? Because some things might have a low chance of success, right? But a low loss in the event of failure. Other things might have a higher chance of success, but a bigger loss in the event of failure and things like that, right? Or, they could be both do really bad or both do really well. And so when I think about it from that standpoint, what am I thinking about? I'm thinking about, first of all, what can I look at for kind of like my base, right? What is my base that I can be protected on? And then on the flip side, I'm thinking about not just one asset, but across assets. And I think this is maybe where a bunch of strategies go wrong. So one of the best pieces of advice that I ever heard was you should learn to think in terms of probabilities. And this is probably a good mental model, not just for investing, but for in life in general, right? A lot of it, I think I grew up in a fairly dogmatic type family, a dogmatic type background. There's right and wrong, there's good and bad. There's what works, there's what doesn't. And okay, that's got some fairness to it. But the truth is also that a lot of things in life are very probabilistic, right? If you're to think about something like doing sales, right? It's just a numbers game. How many calls do you make? Now, of course, you can improve your odds, but the reality is you could be the world's best salesman, pick up the phone, call somebody, it might go badly. The same thing is true in marketing, right? We're always looking at what are conversion rates. We're never saying, hey, listen, we have to catch them all. You'll never catch them all, right? So you're thinking in terms of probabilities. In terms of investments, same idea. No given strategy will always yield a perfect result. But if you can improve your probabilities, that's better, right? So we want to think about both sides. And sometimes what ends up happening is that one success offsets another failure. So it's worth thinking about that, and there's some portfolio analysis that you can do actually on extremely high output deals that are quite interesting. So what often will happen is when they analyze different deals, they'll do something called Monte Carlo simulations, and you'll often find that these somewhat fail because they don't actually account for the real gamut of outputs. So for example, I think I heard that if you'd put like money into Google at the beginning, it went from like $1 million valuation at the beginning to, well, over $1 trillion today. So this is a million X, right? If you'd actually been able to invest at that point, that's 1,000,000 times. Now, why is that important? That's important because that can offset a lot of misses, right? So you don't need a lot of those in order to compensate on the other side. And so the normal thing is you might say, oh, okay, I'm going to get a 10x, and a 10x will compensate for 9 losses, right? But if you get 100x, that'll compensate for 99 losses, and if you do 1,000x, that'll do 999 losses, right? So your numbers start to change in these weird ways if you start to look across multiple outputs as opposed to a single output. Okay, so on any given output, you could have something that's risky, but in a specific one, it could not be risky. And I think this is it's something that I've been thinking quite a bit about lately in terms of societies and in terms of kind of what behaviors are good and in terms of how systems function. So I'll give an example. Generally speaking, in a society, you want a certain percentage of deviancy. So one of the mistakes, I think, within a lot of societies is the attempt to crush deviance, right? Apparently, statistically, they've done models and it's like 2% deviancy that you want. And why do you want that? Because that's where the innovation happens, right? You can think about it from the perspective of a cell. Imagine there were cells that never mutated, right? What would happen? They would eventually die off. It doesn't matter how well adapted they are in their current form, because the environment is changing. If you have no mutations, you'll get killed off. And so the more adaptable, the better, right? So if you think about it from that standpoint, it's not about any one cell, it's about the mutations. And the truth is that most deviants will be bad, right? They won't work out well. So the thought is, hey, we should kill that off, right? We should say, okay, let's get rid of it. But in reality, you want those because once in a while it will pay off. And that's where your adaptation, that's where your growth, et cetera, comes from, right? So I think the same is true in investing. You want to say, okay, I'm putting some of my bets out in such a way that they are risky, right? In the sense that they could go to zero. And you might say, this is terrible. Why are you putting yourself money into something that could go to zero? It's like, well, because if those bets also equally have an extremely high upside, then when one of them pays off, it pays for those losses. Now, let's talk about kind of what you need to think about in correlation to this. So if it turns out that there's a 1 in 10 chance of something working out, right? We're thinking probabilities now. 1 in 10 chance that something is going to work out. Then every single one of those 10 things needs to have a greater than 10x upside, because otherwise it might not work out. So let's use an example. Let's say I put something onto a bet, that one has 100x upside. Then I have another one that's 5x, another one that's 2x, another one that's 12, another one that's 15, another one that's 10, and so on, right? So you might say, okay, great. Well, 1 in 10 is going to pay off, so I'm going to be good, right? Because I placed 10 bets. Well, the problem is if the one that paid off is a 2x, then you lost out. So in order for it to work, and this is a Peter Thiel observation, it's in his book, 0 to 1, you need to have every single one of them has to have greater than 10 as an output, okay, as a possible. Now, it doesn't mean it's going to pay off. Most of them will not pay off. But the ones that do pay off need to be done that way. And you can structure a portfolio in that way, okay? Likewise, if I'm in a situation where I'm placing bets and some of my bets, I was talking to somebody the other day and they were asking, following the one video I'd done on investing, they said, you know, what do you think about just putting it all into crypto because the upside is so high? It's like, well, here's the thing. If you're wrong, that can go to zero or close to zero. Whereas, and you can be wrong on timing or you can be wrong on value. You can be wrong on either one. Whereas if you have some different asset classes, then if you are wrong on timing, you'll be able to redivert some assets from that area into this one here and make that work out. But if you're all in here, then you can be screwed, right? So when I think about risk, I think about timing risk, I think about value risk. These are the first two things, okay? Then I think about is there some baseline value that I can rely on in the event that things go wrong? So a great example of this is if I'm holding a piece of property, right? I might be wrong about whether it's going to go up. I might be wrong. I was just looking at a friend and client sent me some beachfront property in Lombok in Indonesia. Okay, and so it's cool. You know, you had this fairly inexpensive property, and I can look at that and I can say, okay, well, if that's leasehold, I could basically go to zero. If I can be freehold, then maybe it could be okay. If I can generate some cash flow, you know, I'm thinking maybe it will go up, but you know, at least if I can hold on to it. If I look at some place where I'm buying a property, I think that the market is down, and if I'm wrong, maybe it turns out the market just stays like this or goes down a bit. Okay, there's some downside. But at least I've got a tangible asset. I can't lose it all, right? But if I'm in an environment where there isn't a proper legal protection, it could be seized or something else, then maybe I can lose it all. And this is one of the reasons, by the way, why a lot of very wealthy people coming from, say, Africa will be willing to buy enormous amounts of property that doesn't seem like a good deal in some place like Dubai, is because in their home, that money could just vanish. Here, at least, it's like pretty protected, which is why they'd like to go to London, they'd like to go to New York, they'd like to go to San Francisco, they'd like to go to Sydney, etc. Putting their money into a space where it's not about the return. That's like a weird thing for someone coming from a place where you're thinking about the return. It's like, no, it's about preservation. So I do think about it that way. So I think we need to understand what's the baseline. How can we fall? We need to be able to stay in the game long enough to have the wins. Because if you're in a situation where you end up just keep showing up to bat, right, again and again, and you're taking bets on high output bets, even if they're low probability, eventually one's going to hit. But to do that, you have to be able to sustain yourself in the game, right? If you're out of the game, you can't do anything. So that's a bad thing. So the first thing is, what's my downside protection? Okay, I think about that when I think about risk. Second of all, I think about what is the probability that it's going to work out or not. And the truth is, I'm probably not considering it high enough. A general rule in thinking about probabilities is we tend to underappreciate the effects of rare events, right? We often say, hey, listen, we consider a rare event less rare than it is, or sometimes more rare, depending on how we're looking at it. So whatever I think, I should probably build a margin of safety in, right? So if I think, all right, what's the probability that this works out? I looked at 3 different deals today. Okay, so 3 different early stage company investments. All of them looked interesting, right? So I can look at them and I can say, okay, what's the probability that that works out? Well, maybe it's like 1 in 5, right? Let's say that's my instinct. All right, well, if I think that it's 1 in 5, probably I should bet on it being like 1 in 20, right? Because I'm going to tend to be overly optimistic about it, and so I should scale it back. So that's, again, kind of this thinking in probabilities thing. Next is I want to think, okay, how can I allocate that across multiple bets so that collectively it's going to work out? Then I'm going to ask myself, what about correlation? Okay, so are all these going to perform together? So a great example of this is today, Bitcoin hit an all-time high. A lot of the crypto market was up today, right? Generally, when it's up, it's up. When it's down, it's down. But crypto is highly correlated. So you're not going to be in a situation where you really win by trying to diversify between tokens, right? It's not like there's really diversification. There might be diversification in upside, but in downside, like when the market does badly, the market's going to do badly, and it's going to bring most of the crypto down with it. So that's a negative, right? Then I might look at it and I might say, okay, well, those are all fine, but what about on the flip side? Is there any sort of protection against the timing piece, right? And so, again, if I'm going to stay in the game, what do I have to consider? Well, I could be wrong about the timing, right? We said we have value and we have time. If I'm wrong about the time, I may think about, am I diversifying myself across multiple time frames, right? Am I buying when things are down, right? That's the next thing. And am I buying something that produces some yield? So one of the big things that excited me about crypto, and I've done some videos on this, in 2020, or maybe starting in, I guess, let's say 2020, was that we got to this stage where you could have yield, right? So it used to be you would buy your token and that was it. It's like, okay, if I'm wrong about it, it's gone down. But if I can stake, if I can lend, if I can yield farm, well, now I can earn a return on my crypto without having to sell it. So I have right now some tokens that are deposited into staking protocols, and it turns out if I'm wrong, well, they're earning 92% or something right now. Now, that amount will change, right? So don't think about the 92%. The 92% means nothing. The point is that it's productive. It's like there's going to be more of it in the future. So that allows me to be more wrong if I hold than if I simply was holding something that was non-productive. So those would be ways that I think about it. So let's just kind of recap. Think in probabilities, right? Very, very important. And I'm thinking about what is the probability. And when I'm thinking about the probability, I'm thinking about asymmetric risk to reward. Okay, so I'm thinking, what is the downside compared to what is the upside, and what is the probability of the downside versus the probability of the upside? In other words, if I have a 90% chance of failure, then I need to have at least more than a 10x upside, probably a 20x upside, right? So if a 90% chance of failure, then I can say, okay, well, I can compensate that by being across multiple things, and I want to think of it as a basket as a whole. Then I want to think about, is there downside protection, right? So for example, there's kind of a limit to how low it goes. Again, if I think about crypto versus stocks, a stock can go to zero. Crypto tokens won't go to zero. Now they could decline massively, but the kind of nature of these tokens is they'll hang out on the blockchain. You've got all these ghost projects that are just sitting there, right? So that's something. Normally I think about it in terms of real estate and in terms of doing loans. When I have a secured loan, if I can say, okay, great, I have this margin of safety, right? In other words, it could drop from here to here and I'm still protected. And if I'm here, I have a hard tangible asset, something that I can grab, whether it's a title, whether it's a mortgage, whether it's something in trust, whether it's insurance, some of these things that give me a baseline of protection. It's never 100%, but a baseline of protection, okay? So I'm thinking about that. Then I'm thinking about value across time and how that's gonna change, right? I'm gonna think about staying in the game. So like, what do I have to do to keep myself in the game so that I can continue to come back? Which is a good reason why you wouldn't want to over leverage yourself on a single position, by the way, or across a portfolio. Like sequester your assets. It's one of the reasons why we would talk about having separate legal entities to hold assets in, so that if one, you get a lawsuit or something, you lose that one, but you don't lose this one here, so you can stay in the game, right? And yeah, so those are some of them. It's worth kind of thinking about these different factors. And yeah, I would love to hear from you. I hope those are helpful, and we can discuss it further. We will talk to you on the next video.